Okay, so now that we have built our backlog report, let's see what it's like to build the over/under billing report. And just as a reminder, this is your classic WIP report. I think this is the one that a lot of us think of when it's time to build a WIP report. So your over/under report doesn't have to look like this, but at the least you might be able to pull some ideas or principles out of this particular report. So here's a reminder, the focus of a WIP report or your over/under, or sometimes when you're talking to your accountant or your bonding agent, it's a schedule of projects is what they'll call it. But either way, one of the objectives of this report in that context is to determine whether you are overbilled or underbilled at the year end, because there's going to be an accounting entry or a true up, if you will, for your review. Your accountant's job when conducting an accounting review, among other things, is to accurately report what your actual performance was. So on an accrual basis, they'll go through and actually say, hey, your project actually earned this much revenue. The intent of that review is to give a more accurate picture of your true performance during the year. Let's jump back to our primary inputs just as a refresher and just think about, okay, we're going to be focusing on our 6 primary inputs, and let's see if we can identify these inputs and how they are incorporated into an over/under report. So when it comes to revenue, we're wanting to identify what the contract value is. So as we look at this other WIP report, we might see a combination of these. But it's really truly we're capturing the idea of what the contract value is for the project. Now, when it comes to costs, we're going to be thinking about what did we sign up for? What did we project? So you have an original budgeted cost, and then when you combine that with any of the changes that have occurred for a project that's in progress, that's going to give you the accurate picture of what you are now planning on spending for that project. And as it comes to just the actual activity for the project, you're going to want to know, okay, well, what have I actually billed and what are my actual costs to date? So here we are on the over/under report. Let's go ahead and just identify what our total budgeted costs are. Okay, so we've identified what the budgeted costs are for all of our projects. So you'll see that on this particular report, we have categorized or separated our contracts or our projects between completed contracts or completed projects and those projects that are still in progress. One of the reasons that's important is because as we prepare ourselves for the following year, it's probably important to remember where we left off. The accountant's going to be looking at each of these projects in our next review and anticipating that these are now going to be up inside of this completed contracts portion. You're going to want to make sure that we're creating continuity on from year over year on what we're reporting as in progress in one year and then what has been completed the following year. Okay, so now that we've identified what the total budgeted cost is, let's go ahead and work on our next primary input, which is what is the contract revenue, or what is the revenue that we are planning to bill for the entire project. You'll notice here in the total estimated revenue, this is now still, and we're using the word estimate because the project is still in progress. Things are still changing. But as of the date that we are pulling this report, we're focusing, from the perspective of as of the end of last year, this is what the project snapshot looked like. Okay, so now here just comes a couple of bells and whistles. Let's just figure out if this is how things are lining up on the completed projects, what was our actual performance? What was our gross profit or loss? And then our gross profit or loss percentage. Okay, so now that we've done a few calculations, we can start to ask some really interesting questions like, why did that job make so much more? Or like, wow, that's really interesting. What in the world happened? 48% on that. And as you start looking at it, you're like, well, that makes sense. I mean, you start thinking, well, that makes sense. I guess it was a smaller project. And so you're going to start seeing some bigger swings in margins. Maybe it was a stipulated sum versus the time and material. If it was time and material, I probably would have anticipated seeing a bit more of a consistent margin overall. But as you drop down and you kind of look at the year overall and say, okay, well, for the projects that we've completed last year, overall, I had a 14% margin. Not bad. So now let's take a look at the projects that are still in progress, see how we're tracking. So, I mean, truth be told, just the profit and loss as a number is, I guess, nice, but the real analysis comes when I'm looking at a margin ratio or a margin percentage. This is supposed to be looking at the project from an overall perspective. And so the fact that I'm seeing 2.7%, it's got me a little bit worried. My next question is that really what we're tracking for, or are there possibly some changes that have not yet been booked? Like, hopefully what this is, the hopeful explanation for this particular project is that I have some prime contract change orders that haven't been approved or booked, or maybe something is hopefully missing from this revenue amount to help me feel better about the fact that right now I'm tracking for only 2.7% profitability. And this is without any kind of overhead burden or labor burden, whatever you want to call it. Or maybe it's possible that my budgeted costs are being overstated. So I would want to go look at that. So that's a really great example of how a WIP report, when I start breaking it down and looking at it from this lens, it really starts to become kind of a detective game in a way. And I get to start diving deeper and asking really great questions about what's going on these projects. And the more frequently I do this, if I do this more in real time on a monthly cadence, think about how many problems can be prevented. And we'll hit on that later on in this discussion. So depending upon the time of year that you're actually doing your review, you will need to make sure that it's really clear that this report is from the perspective of through the end of the prior year. And so bringing clarity about actual costs and actual build only through that time frame is going to be important to present the information in a way that creates clarity for the prior year performance. So that's what this particular section is intending to accomplish. Now, here's an interesting thought. If we're creating a WIP report manually, we're in Excel, so just stop and think about how many different reports we've had to pull just to get to this point right now. So a total budgeted cost, that's a combination of, okay, where did I store the original budget, or how did I figure out what we were planning on spending in the first place? And then how do I go and figure out whether or not that plan has changed? So a couple of reports right there. Now looking at the revenue, maybe you're scraping a CRM or something to figure out what the original agreement was. But if changes to that agreement were not logged properly, or if they were maybe recorded somewhere else or just in an email or something like that, now I'm going and I'm having to really be a detective and investigate and interview my team members to find out whether or not that revenue number is still reliable. For this particular section, now I'm actually looking at hopefully my accounting system, because that's the truth. That's what I reconcile to. So I'm going to have to pull some sort of job cost report or a cost report that at least gives me a summary by project to scrape and figure out what my actual costs are as of the end of last year and what my actual billings were as of the end of last year. So let's go ahead and fill out that section. Okay, so now that I have my actual costs, my actual building, I got a pretty good foundation to know what's going on for this project. Now this is interesting. On our projects that are in progress, this is telling me that I have a project that I have booked $255,000 in costs, but I have not yet built anything for that project. So a real opportunity, or let's say that's a real red flag from like a cash management perspective, that, hey, we don't need to be financing $255,000, or maybe $78,000, $118,000. So these are all projects that are in progress. I have booked costs and I have yet to book revenue. So now I'm able to start peeling back the layers and examining the performance of these projects, or at least like how we're doing on keeping up with our progress billings to date, or at least as of 12/31. Very well could be that these projects were billed at the beginning of the year. Maybe there's a little bit of a tax play going on here. You never know. So with that in mind, I think I'll introduce one other element that I have personally done that helps me answer those questions a lot quicker. So when I prepare a WIP report, and I know that I'm focusing on the project through the end of the prior year, I know that these questions are going to come up. So with that in mind, I'm going to prepare additional information for me to just look at and quickly answer questions about revenue timing or cost timing. let's look at that part of this report. So sometimes when we're preparing these WIP reports, it really does become a bit of a game of investigation. There's some mysteries that we have to solve. So for that reason, I actually create these little portions for any activity that happened prior to the review year. And then I separate the costs and revenue for the year being reviewed. And then any costs that happen now, depending upon the time that you do this, the farther out we go into 2025, more activity is going to accrue, and the more activity is going to accrue, and we may have more clarity as to the final result of the project. But it's important to still separate whatever activity happened. Okay, so let's dive into each of these projects on a little bit more of a granular level. As we look at the activity, now these are jobs that were reported to be complete at the end of 2024. So there's no surprise that we're seeing activity in 2023 for projects that were completed in 2024, and we're seeing a pretty good bulk of activity for 2024 for these completed projects. Now, what's really interesting is when I move over to 2025 and I start seeing that there's still activity for projects that were reported to be complete at the end of 2024. So this starts to become a really fun question. And I think anybody looking at this, you might have an idea on what happened. But if I see a small cost that came into 2025, that could be maybe my office staff booking time to the project for closing it out. It could be that maybe we had to make a warranty call on the project to check on something. But the fact that I'm seeing such a small amount of costs in 2025 for projects that were reported to be done in 2024, that actually gives me a sense of confidence. I'm actually really happy that that's what's going on. If there was nothing, I mean, I guess that'd be okay, but that would also be a little bit weird too, that no costs, nothing at all, for at least for our business, where when we build a building, we commit to a certain warranty timeframe, and it's not totally uncommon to make sure that you run out and teach someone how to use the thermostat or something. Not necessarily a warranty issue, but it's definitely a relationship management issue, helping people out even after we turn over the building. Now you're going to see the impact of this later on as we actually dive into our over-under analysis, but that is the answer to some of the questions that we were looking at earlier, wondering, okay, why am I not seeing, actually those were down lower. So as I'm looking at these particular numbers, I can pretty much count on the fact that in a minute when we do our over-under analysis, those are going to show up as probably some amount of underbilling. Logically, if I build the project in 2025 and it was done in 2024, that is essentially the definition of being underbilled. Let's see how we're doing for projects. Now, these are projects that are still in progress moving into 2025. So this is a lot more consistent with what I would expect to see, knowing that, yeah, these were projects that were still active at the end of the prior year. So what a relief that stuff is still happening on them. So that's very consistent with what I would hope to see. Now, some of these projects that are still active in 2025, and I had some activity going on even in 2023, this tells me that these are projects that we likely were involved very early on, probably from like a design build perspective. This is just a really big project, and so it spanned a longer time frame. And then beyond that, yeah, that seems pretty consistent. Okay, so now that we've got to the most exciting part of this entire exercise, the over-under analysis. Now that we've done some really exciting formulas, we can start really digging into this thing. It'd be really exciting. So, in fact, let's introduce some of these formulas. Like, I have them written here, but maybe it's easier to see or digest from a different view that I had prepared. Okay, so we've been pretty well exposed to profitability formulas. Revenue minus expense equals gross profit or loss. Hopefully it's always just gross profit. And then gross profit or loss divided by your revenue is your gross profit or loss percentage. Now, in our over-under analysis, that section that we were looking at in the prior tab, here are the formulas. Here are the formulas for that section. So here are the formulas for that section. And let's introduce this is a concept that is unique to construction finance. It's the concept of percentage complete. Okay, so percentage complete from a WIP report perspective is what have we actually been billed for divided by what we're planning to be billed. Or said differently, what are the costs that we've actually incurred so far divided by the costs that we're planning to spend when we finish the project. And the really tricky part is that each of these inputs come from a different system. So actual cost, true actual reliable costs are going to come from your accounting platform. Your budgeted cost is going to come from whether you're utilizing a project management system or maybe your budget for that project is just still lives on somewhere in a folder and it's on an Excel spreadsheet. When we brought all of that information together on our WIP, it was really just laying the foundation so that we could figure out what our percent complete is. In the world of accounting, there's this concept of revenue matching where you want to match your revenue as closely as you can to the time frame when the cost was actually incurred. And so this formula is what gets us closer to matching our revenue to the time when the cost was incurred. So you take your percentage complete, which we just calculated up with this formula, and then we multiply that percentage complete by our contract value. So that's going to tell us, okay guys, if you've done everything perfectly and everything had matched up dollar for dollar, this is the amount of revenue for that project that you would have booked at the end of the year. Now, once we know what that earned revenue amount is, we can subtract our actual billed amount. This is what tells us if we are over or under billed. So let's just jump from here. So let's go from here and look back into our over under report and apply these formulas. Okay, so here we are. Well, the fact that we separated our projects between completed as of the end of 12/31/2024 and those that were still in progress at the end of the year, no surprises that each of these are coming out to being 100% complete. So in other words, the amount of the actual costs match perfectly with the amount that we had budgeted. And just to dive into that, that's what that formula is doing. Actual costs divided by budgeted costs. Okay, so now let's go and figure out what we should have billed using our percentage complete. Percentage complete multiplied by the total contract value tells us how much we should have billed through the end of the year. So in this case, cool, yeah. So 100% of 420,000. 420,613, and that's what we had actually billed. So, I'm jumping ahead. Well, it's probably to that point anyways, but okay, so now that we've laid that foundation, let's jump over to our final calculation. Let's answer the question. Were we over or under billed? Well, looking good on the first, but this is interesting. So we got this guy right here. Even though we were done at the end of the year, we had actually billed 210,000. So earned revenue was 318,000. So 318 minus actual bill, 210, yields a positive amount over, so that's underbilled. Now, it's sometimes a little bit tricky. People are like, well, if I'm underbilled, it should be negative, right? Well, let's talk a little bit of accounting. So the fact that these were underbilled means that we need to adjust our profit and loss and make it bigger than what we actually reported. Now, there's a reality between accrual accounting, or let's just say managerial accounting and tax accounting. And maybe there's a little bit of an adjustment going on where you're thinking, I'm going to probably push a little bit of revenue into next year. When we go and we prepare our over under build report, it's with the intent to generate the most accurate picture we possibly can of what our actual performance was during the review year. That way an accountant can go, they'll generate that report. And in this case, we've been talking about it from the perspective of we're doing an accountant's review for either renewing or qualifying for bonding, and generating that accurate picture for the review year for a bond underwriter is what they need to be able to determine the risk of a contractor. Is this guy actually going to perform in a way that I'm not going to have to step in and save their skin, complete the project, do whatever? That's what bonding is. Bonding is a form of insurance that the contractor's going to perform. They're going to get the job done according to the plan documents, and they're going to actually pay their bills. It's another important too. There's, step 2, do the job, and if you hire someone, pay them. So I guess sometimes that doesn't happen. And so bonding steps in, fills that gap. So in this scenario, at least for the completed projects, we could say that our overall revenue amount was underreported or underbilled by 653,000 change. All right, well, let's see what the over underbilling looks like for projects that were still in progress by the end of the year. So this is sometimes where it gets a little messy because we're still actively managing this job. Probably at the time that we're doing the review, this project, or at least some of them, are still in progress. So I've seen it be a little bit tricky to shift to the mindset that you're only looking at this project from the perspective of 12/31/2024. So whatever still is going on in 2025, you have to set aside for a minute and really just lean on this particular snapshot saying, hey, from the beginning of the project through 12/31/2024, here's actual costs, here's actual build, and then you can go ahead and then do your over under analysis. And so no surprises, like maybe there's one where this is reporting to be overbilled by 20,000. Now, what would lead to an overbilling? Maybe you talk to your project manager or someone and they say, hey, this is the percent complete. And so that's what you use for your billing. But from a cost perspective, as it turns out, maybe you have a vendor that they're a little late on their billing and they delayed their billing into 2025. So from the perspective of 2024, your costs weren't as much as what you had anticipated, or your costs didn't accurately reflect the actual work that's been completed to date. I mean, that happens. So when you go back and do the calculation, it's going to look like you had overbilled it because your costs hadn't actually caught up to the amount of work that you had actually completed by the end of 12/31/2024. So overall, as we look through this, kind of interesting, that's a pretty decent amount of underbilling. So maybe if you're like me, you're a little bit intrigued by that and you're wondering, well, how quickly did I actually turn around and get stuff billed? So as I go through and look at this thing from an overall perspective, I can see that I was underbilled by a pretty decent amount, almost 3.4 million. I'm a little intrigued by that. So this is when I get to step over and let's peel back our layers a little bit and see what, from a revenue timing perspective, how much can we account for of that 3.4 million? I'm going to go back and I'm going to look at what was the status as of the end of 2024 that may have contributed to that much underbilling. So there's this really big project that is making up a significant portion of that underbilling. So that 2.4 million is a pretty significant contributor to that overall underbilling amount. And as I look back, I see that in 2025, so this current year, we're going to say, oh, I've only booked 2.3, but I've billed 4.9. So there was a massive amount of billing catch up, or at least so there was a massive amount of billing that got pushed into the current year. But bearing in mind that this report is prepared from the end of 2024, that makes sense that a significant amount of underbilling of our total underbilled amount came about because of that one particular project. And knowing maybe let's just pretend like I go and dive into it. It's just a revenue timing or a strategy or whatever it could have been. My concerns are resolved. This isn't necessarily an issue. It's just I'm from the perspective of my accountant's review, I just know that my current year, my 2024 reported performance is going to be increased by 3.4 million. So you combine that with the projects that were completed at the end of the year, and yeah, I was underbilled by about $4 million. I don't know if that's necessarily good nor bad. That's what's going to be pushed into my revised profit and loss. And I mean, overall, it's probably a good thing because it's going to make me look more profitable for my bonding underwriting. Okay, so now moving away from the spreadsheets, back to our conversation. Now, if that seemed super tedious, that's only because it is. So I'm going to take this opportunity to just introduce a few things about what ControlQore is doing to make this whole process better. Now, bearing in mind, I am biased, full disclosure, being head of product for ControlQore, I want to showcase what we're working on, what we've been able to do. So here at ControlQore, we've built a product that aggregates all of those primary inputs into a single location. So our project agreements so that's our contract value portion, any of our commitments, so our actual budgeted costs, and then any of the change orders, whether it was to the project agreement or the prime contract or any changes to our commitments, that's all being aggregated or consolidated under one roof, making the generation of those inputs, which are really tricky to bring together. We're putting those under the same roof. Then we take those primary inputs and we pair it with our construction specific accounting and approval platform. Now you're capturing all of your dynamic information. Now you might be saying, that's nice and all, but what's different about that? Or it's just an accounting platform, right? When you think about the products that you love the most in your life, it's usually because they have made your job easier. With that in mind, we've tried to create a transactional ecosystem that users actually want to use. You don't have to coerce people to come in and submit their invoices in a particular way because that's your way and it's your way or the highway or whatever, because you know you need that information into whatever database you're going to be generating your WIP report from. But what if you could actually create a system where it's more convenient to run your bills through and your credit card transactions, your vendor payments, your client billing, your client payments? What if it was actually more convenient to run all of those transactions through the same application that is generating your WIP report? And that is actually what we've done. That's the exciting part about ControlQore, is that we've really thought about what makes a good bill approval workflow. What makes a good credit card and expense management platform? What makes it easier to capture all of my transactions, all of those costs? And what if I could make a really great experience as it comes to preparing my draw requests and sending invoices to my clients and booking that revenue? Well, that's exactly what we've done. So instead of relying on your sweet Excel skills, your accounting system compiles everything and calculates the rest. Now you have a reliable WIP report that's only a few clicks away. Okay, so let's jump kind of high level again. So how should company management use a WIP report? It's important to remember that these reports don't just hand you all the answers, but they can help you ask the right questions. In fact, the hard part usually isn't calculating numbers. It's knowing what to ask once you see them. And we saw some of that come up as we were building our WIP report, and we got drawn into some of the numbers, some of the variances that just kind of jumped out at us. So you take the backlog report, for example. Remember, this helps forecast future cash flow. It's a valuable tool for sales and estimating to identify the types of sizes and jobs that we should be pursuing, as well as the urgency that maybe we need to have, because we can see that, hey, we're quickly approaching a dearth of cash flow. So now let's take a look at our over-under report, the one that we just wrapped up preparing. Remember, it's your snapshot in time report. So if you're overbilled, you've accelerated your cash. If you're underbilled, you might be acting like the bank. You're floating the jobs. Reviewing this report allows a manager to dig into declining profit margins, and it also helps flush out costs that maybe they were allocated to the wrong job. So to wrap up, why should you invest in WIP reporting? Whether you're investing in software to automate your WIP process or grinding it out manually in Excel, the payoff is the same. You'll know what the revenue, whether you're investing in software to automate your WIP process or grinding it out manually in Excel, the payoff is the same. You'll know what revenue has been earned, you'll understand how your jobs are performing, and you'll be able to project future cash flows with confidence. And that, my friends, is what the start of control looks like, which is way better than being out of control. I can promise you that. And until next time, stay focused on what is in your control, and the rest, you just gotta let go. Thanks.